Good afternoon, Market Rebels, and happy Friday, everyone. I have to start off by apologizing for yesterday. I don't know what happened, but I had about 103 temp, was completely out of it for 2 days, but I always believe the show must go on. So I basically had to crawl on my hands and knees to get in this chair. I said, we got to get it done. And as I'm sitting here, John, my tech guy, says, are you sure you're going to be able to do this? And I said, well, now that you mention it, I don't think so. So we gave it a good, honest effort, but just wasn't able to pull it off. So I've had a lot of nice text messages from some of the participants at RebelCon, and I said it must have been the armadillo milk. So everybody who is at RebelCon will certainly understand. But I feel a lot better today, but hey, that happened. So I appreciate you understanding. But the presentation that I wanted to do yesterday was a topic that we talked about that Stu and I did in one of the breakout sessions. It was just a small segment of it, and that is the goalkeeper bias. And I think this is a really important topic for markets like these. And what is the goalkeeper bias? Well, it started with a research article from the Journal of Economic Psychology. And in 2008, there were a couple of Israeli researchers that analyzed 286 penalty kicks in professional soccer. And you have to realize that Israel was very popular at this time for developing what's become behavioral economics or behavioral finance. Kahneman and Tversky were really the founding fathers. Daniel Kahneman actually won a Nobel Prize in 2002 for his work. So a lot of this research was coming out of Israel at this time, and I just thought this was such a fascinating study. And so here's what they found, is that 33% of all of the penalty kicks, okay, so keep in mind that penalty kicks are a big deal in soccer. They can certainly make or break a game. 33% of the kicks went to the left, 33% went in the center, and 33% went to the right. Kind of what you would expect. We don't really know which way to go, so they should be about even. But what they found is that 6% of the time that the goalie stood still. 94% of the time he broke either left or right. So let's say roughly 47% of the time broke left or right. Kind of interesting, isn't it? You would think that it should be roughly 33%. And in fact, I'm sure that professional coaches in all sports do incredible detailed analysis of stuff like this for this very reason. And yet they still have this bias towards going left or right. So the question is, well, why should you stand still? Well, what they found is that if the goalie stands still and does nothing, he appears indecisive. And by choosing a direction, he's at least taking action. And that's going to become important. And so the idea is that people feel better about bad outcomes if they at least took some type of action. And so that's what happens a lot when we have, let's say during a downturn, and people say, oh, I need to make some type of action. I've got to do something. Well, is that really true? Sometimes it does turn out to be true, and other times it doesn't. But people want to take some type of action. So here's something. Will stop orders work? You see a lot of people go, oh, I better place stops because things are getting a little dicey. We could also say that maybe it's the strategy of getting out and back in. Same idea. I'm going to sell my positions and I can always get back in. Well, in order for that strategy to work, you not only have to get out in time, but you must get back in before that price is exceeded. Because if you get out at 100 and the stock falls to 90 and goes back to 110 before you get in, did you no good? It's a temporary satisfaction that you did something. And yet it probably, or at least in a lot of cases, isn't your best bet. Now here's another thing I always point out. Let's say that you have a 70% chance of being right as to when you should get out and a 70% chance of being right when you should get back in. And that's being overly generous. I don't think anybody would have a crystal ball that highly polished. But even if that were true, there's a 49% chance that you're going to be right on both counts. Not even as good as a coin flip. So think about that, 70% chance in both cases, and you'd be better off just flipping a coin. And yet people do this because they think, oh, at least I did something. So let's take a look at some examples. If we have a chart like back during COVID, well, right here halfway through, the SPY was at about 276 and the VIX was 55. Now, a lot of people would look at this chart and say, oh, look at that precipitous fall. If you had just bought puts, think of the money you would make. Not necessarily. That's forgetting about price. Remember, anytime that there's a benefit, you have to pay for it. So we forget that, right? We forget that you have to pay for these puts. So what was the VIX down here at the bottom? What was the SPY down here at the bottom? The SPY was 218 at the bottom, 58 points lower. That's it, 58 points from this midpoint. Now, the reason I chose the midpoint, when it first starts to turn, people are usually not going to panic. But after it starts showing that it's a downtrend, people start to get a little nervous in here. They might have held off on this first little rally in here, and then once it turned, this is when people really started to panic. So think about this. It's 58 points lower. And yet, how much did you pay for implied volatility? 55 points. The market gets really good at predicting what is a reasonable fee for this benefit that we're buying. So in that case, it did you no good, and that's assuming that you sold at the very bottom. So you have to think about that. You spent all of this money on the puts, pretty much was a wash, when that could have been money that you spent buying more assets that would appreciate like we did here in the future. Why don't we do it? Because we want to take action. We say, I've got to do something. I'm not interested in buying or building a portfolio. I've got to do something now for my team. I've got to make something to protect the downside. Okay, so you have to realize that that is not, in most cases, a good strategy to do. So when should you exit? Well, ask yourself, how much am I willing to lose? These are questions you have to ask before you get into the trade, when you're thinking clearly and the markets aren't on fire. Is there a price that will convince you that your initial outlook was wrong? This is one that I live by right here. I think it's incredibly important. Is you buy stock at 100, is there a price that's going to convince you that you're wrong? Well, if I buy stock for 100 because I think it's going to 300 over the next 5 years, why do I care that it's at 98? Does that mean I'm wrong? Why would I care if it's at 95 or 92 for that matter? See, but at some point, you're going to have to say, you know what, I think my initial thesis was wrong. And let that be a mental stop, or maybe a place where you buy some puts before you're paying 55% volatility or 85 like at the peak of COVID. That's not the time to be buying insurance. Okay, so another thing to remember is that using stops or getting out and getting back in doesn't increase your chances that the next trade will be right. I always love it when traders say that, well, I got out because I just moved into something else. Well, what makes you think that that's a better trade? If your intuition was that good, the first trade wouldn't have gone against you. See, again, there's psychological crutches that I'm doing something and now I've moved into a better position. And you have to say that's not the time to be making those decisions. So the thing to remember is that you don't want to manage risks in downturns. You are under high stress, you're going to make snap decisions, and you're going to feel forced to do something. You're going to buy options during high volatility. And if your trading decisions are forced by losses, you won't be successful. So what do you want to do? You want to manage the risk beforehand. It's never a good idea. It's really a fundamental principle of financial risk management. Don't try to manage the risk during the downturn. You want to take care of that beforehand. So risk is managed before things get bad. That's probably the biggest key to take from this presentation. So as always, I'd like to remind people, if ideas like this are new to you, imagine what you can learn in a short time with one of our world-class coaches. Many have decades of trading experience on the trading floors. And we are offering, check that out, a free 30-minute one-on-one assessment $100 value. Give the number is 888-809-8058, and be glad to have a chat with you about any topic that you want. Could be an actual trade, could be theoretical, anything you want to talk about. But it's just to get a sample of things you didn't even know you didn't know. And that's what happens when you open the doors to people who have decades of hedging, rolling, and morphing experience with options. So please give them a call. And I hope that helps. And again, sorry about yesterday, but look forward to picking back up next week. We'll get back on track with our normal Monday, Thursday, and Friday, 4 p.m. Eastern. Hope everybody has a great weekend, and we'll see you then. Thank you.